to be fair, there has been a big outflow from Cathie's fund, but a lot of money has stuck with her. So I think that's because she didn't change. She's still Cathie. She's still publishing the research. She's still transparent about what she does. So all the good stuff's still there. So, I mean, if I was Cathie, I'd just say, screw the world. I'd just carry on doing what I'm doing.
Hey, fellow Stock Guardians, welcome to the show. Today's episode is a special one for me because my guest today is one of the YouTubers that I personally watch and listen to his content. Ramin Nakisa is my guest today from PensionCraft YouTube channel and community. Ramin was an investment banker before he became a YouTuber. He's also author of a very successful book for hedge funds and investment bankers, and another successful book for individual investors called Invest in Fear. And I'm so excited to have him on this show. We had great conversation about why you shouldn't buy the dip. We talked about his YouTube channel, PensionCraft, and we even talked about whether it's the right time to buy the dip in ARK Invest in Cathie Wood's portfolios or funds. So without further ado, let's get to the show.
Thank you, Hoda. Thank you so much for having me.
So Ramin, maybe we just start jump into what is the history or the story behind PensionCraft, and why did you start this YouTube channel and this company?
Well, I was an investment banker for a long period of time. So whenever you're an investment banker, it's kind of like being a soldier in World War II. There are lots of casualties all the time. So everybody has an exit plan, and mine was to start some kind of education for retail investors. So we were writing research for, hedge funds, pension funds, sovereign wealth funds. And what I thought was, why don't we create this quality of research, but for retail investors, normal investors, because that was just not there. And particularly on YouTube, I just thought a lot of the quality of the content was just terrible, where people were just kind of opining about stuff, not giving their own, not ever really kind of backing it up with facts. So I thought it would be nice if we had something similar, but for retail investors. Now, of course, that means that you have to explain stuff, because, if I'm sitting with a hedge fund manager, I don't have to explain what a convertible bond is. They know all that stuff, hopefully, but you're not going to explain it to them if they don't. Whereas with retail investors, a big part of it is explaining it. So, that's the big difference, I think, between what I do now and what I did then. And, I still think there's a big gap in people's education in terms of knowing about investment. We're never taught this stuff in school. And so, I feel as if that's kind of what we're trying to do. Fill that gap, keep it factual, less kind of opinion-based. I know we'd get more clicks if we were more opinionated, but we really haven't gone down that road. And also kind of doom porn gets massive views. If you're just miserable all the time and say markets are going to crash, lots of clicks, but I don't want to go down that road because it's just wrong, right? Most of the time, things are okay. So that's the kind of ethos behind it. We're trying to educate people, keep it factual, and, help people do stuff which will succeed in investment.
Yeah, that's why I love your content. I've read somewhere being pessimistic sounds to be intelligent is one of the way to sound intelligent is to be pessimistic and always say crash and it's not going to work. We're all going to die. Everything is doomed.
Yeah.
And obviously that's a really good engagement hook that a lot of YouTubers use. But I love your content in terms of how it balances education and shows the opportunity and explain the opportunity. And also we're gonna talk about it. You also talk about things that you shouldn't always buy the dip or you shouldn't always follow the momentum. There's a good way to buy the dip and there's a good way to buy the momentum, but not all of it is always correct. And so that's what I'm so excited to have you on this show and have a conversation with you. But before we jump in, you also wrote 2 books. Do you want to talk about them? Maybe we can, we obviously would put a link about those books in the show notes, but it would be great to kind of get a sense of what those books are and whether users should pick it up and read them.
Yeah, the first one was called a Financial Bestiary. Now, it's not what you think. It's not that word, okay? A bestiary was like a kind of medieval book, which had, creatures, mythical creatures like a salamander or a dragon, and each of them had a kind of spiritual lesson for you as a human, as a Christian. But the idea was that I'd have a kind of picture book for people in investment banking, or maybe on the kind of buy side as well. So it would have like, this is a trader, this is what they do, this is a salesperson, this is what they do. And I had actual people who I'd met through my work. And, it was quite popular because it explains who does what. And then it also had a kind of picture of, this is a bond, these are the cash flows, this is a convertible bond, this is an option, and this is what it is. So it was just like an introduction into the kind of knowledge you'd need at an investment bank, but you'd be too embarrassed to ask. So things like, how do options work? How do you actually price an option? Because if you actually speak to a trader, they won't say, I use maths, I use Black-Scholes theory, I use a martingale process. No, they say, this is how we do it. We just hedge the product, and the hedging cost is the cost of the option. So it's nothing to do with maths, it's about risk. So that kind of intuitive understanding of how the products work, how they fit together, and also who does what, I think that kind of big picture stuff is what went into the bestiary. And, I kind of poured my heart and soul into it. It took me about 4 years to write it, maybe a bit longer. Every night on the tube, I'd be kind of, squashed in on the tube and writing this after a 10-hour day at work.
Oh, wow.
But it was great fun. It helped me to unwind, and, it created a lot of opportunities for me. And then I did a book on volatility trading called Invest in Fear, because I heard that people like grandmothers in America were buying VIX funds or even derivatives based on VIX. And I just thought, do they really understand what they're buying? And I thought most of the time the answer is no. So I tried to explain exactly how they work, what the problems are, how it fits into a portfolio, that kind of thing. So that was my second book.
Wow.
And now, my videos get so many views, more than my books have ever got. So I'm not sure that writing another book is kind of worthwhile.
Well, the medium has changed, right? Has evolved. It used to be written medium, and now we have obviously the fortune of seeing you or seeing the creator and sort of interacting. So it's got really, I guess, interactive and different. It's on my to-do list to read this book. Invest in Fear sounds super cool. And then the bestiary. First time I read it, I saw this beastery, and I'm like, okay, this sounds very interesting. But yes, thank you for introducing those books. Definitely will put a link to it. But let's go back to the topic of the YouTube channel. I watched one of your videos. It's one of your most watched videos, actually, and it's really intriguing. The title is "Don't Buy the Dip." And I was immediately struck by it because I love buying the dip, and it doesn't always work the way I think it should work. So that's why I kind of watched it, and then I really found it fascinating. So let's unpack that if you're okay with this in this video, and have a chat about why people should not buy the dip. Ramin.
So I think most of the people think about okay, when markets go down, it's a good time to buy. Okay, that's true. But the way I looked at it was to say, for most people, from the age of about 20 to about 60, you actually earn money, you save money monthly. So the real choice month to month is, if I receive $1, do I invest that into markets regardless of what happens to the price of the market? Or do I withhold it and kind of keep it in the form of cash, ready for when markets fall to some reasonable valuation? So those are your two choices. And then you can choose a threshold for valuation. You can choose different measures for valuation, or you can base it on how much the price has moved relative to the previous peak, say. And what I showed with these back tests was that there's never a threshold at which it's better to withhold cash ever. So it doesn't matter what you choose as the valuation measure or the kind of threshold, it's almost always better to just carry on buying regardless of price, to be a kind of price insensitive investor. And the simple reason is that, equity markets tend to drift upwards. So withholding money, it just doesn't work. Also, because of that drift, the sooner you put money in, the better. And, and valuation is just such a poor measure of whether equity markets are going to fall further or whether they're going to carry on rising. It's pretty much independent of that. So, for those two reasons, it just doesn't really make sense to withhold money. So if you do have a dollar, you just invest it as soon as possible. Most of the time, that's the best thing to do.
That's a really good point. A few years ago, I did this sort of like back test, and I downloaded the data for Japan sort of index, and then S&P, SPY, S&P 500, and then some other countries like index for their economies. And then because the conversation was based on a conversation in our Facebook group at the time, that investors in Japan got all the worst of the worst because the market hasn't even recovered. And then people were saying that, well, look at the Japan example, you shouldn't have been buying the Japan market because you would have lost because the market hasn't gone bad. And then to your point, I ran the simulation of had I bought Japan's market at the top and then keep buying as it was going down, and this was like 2 years ago, to that point that I was doing the analysis, I would have still gained and improved my value, even though I would have bought some of the money at the top of the Japan's market and then kept buying on the bottom, and as if like it was an automatic investing. I would have not lost money, and I would have actually grown my investment. And so it sounds, to your point, it sounds very intelligent, and it sounds that it's a good idea to buy the dip, but you actually, if you look at the numbers, it doesn't work it that way. So if you just keep buying, you're going to be the winner. But why is it so hard to accept that fact? Because the math say it, but there's still this whole buy the dip. As I confess, I love buying the dip. If something goes down, I'm all like out of my mind. I'm like, okay, let's go buy. It's like there's something going on in the market. Why do you think it's so hard as an investor to accept the math? And it's always we want to fall back in our own sort of like natural intuition, I guess, of like, oh, the price is down, let's go buy it. Do you have you found any reason, because you have the professional background as well, in why this is so hard?
I speak to a lot of people one-to-one because I do kind of coaching as well. And I think usually it's the opposite, which is that people actually don't like buying when markets fall. So usually they're terrified. When I speak to people, usually it's people who've sold a business, so they've got very large sums to invest, or they've inherited money. Those are the people that are most scared. And I think for them, the best way to get them into markets is to drip feed. But generally, they don't want to buy the dip. They don't even want to buy if markets are falling, so that's the conversation I have most often. So people, I think, are kind of irrational. And it is kind of weird, right, with equity that, it's one example of something where if the price falls, people are scared to buy. It kind of seems weird. So, if you are willing to do that, as you are, and as many of your watchers will be willing to do, it's the best possible behavior, right? So I think, if anything, buy more when there's a dip. That would make sense. But certainly, I think for me, it's the opposite. I find people who find it difficult to buy when there is a dip.
Interesting. I guess I went by the number of buy the dip videos that we see on YouTube popping up as everybody's just talking about it. And I thought it's just irresistible for everybody, as it is to me, to keep buying the dip. I have to say, it's a lot of times doesn't pan out as you hope, right? Because you look at a stock, it's a really, or an ETF, it has tons of good holdings in it, it's a good management, good track record, all that good stuff, and then you buy, it's down 50%, and then you buy it, and then it goes another 5% and 10%, and then you're like
Facebook, right? It's kind of had a horrible fall, and it hasn't really recovered much. So I guess people just think, well, there's something wrong with this, or there's something I haven't seen. What do the other people know? Is there some piece of information which I'm missing, which the rest of the market knows about? So I think if you don't have your own kind of objective valuation of a particular stock, then, it's hard to say that something actually has value. But if you do have like a discounted cash flow model that you believe in, I think that's probably the best way to approach this kind of thing, because then at least you have a kind of feeling for when something's worthwhile, or, maybe the sector's out of favor, or people are just scared about a particular thing. So for example, what's going on in Ukraine and Russia at the moment actually probably creates quite a few opportunities.
Yeah.
For example, one of my clients was just talking about BP, British Petroleum, and they have a subsidiary called Rosneft, and that has a big Russian exposure. But the stock has suffered as a result of that exposure. But actually, the profits last year were great because the price of oil is very high. So
Yeah.
that's one example of an opportunity that's created by just having fear.
Yeah.
But if we do kind of arbitrage human nature, I think there are lots of opportunities there.
Yeah. And what is actually your point? You brought up the oil situation, but what? And then I think the one part of the market these days is this whole so-called work from home stocks or COVID stocks that are we've seen crazy crashes happening. The I guess the poster child of it is Cathie Wood and her portfolio of ETFs. What is your take on that? Is that a good buy the dip opportunity, or do you think investors are just in for a lot more surprises downward before anything turns out? How would you evaluate those sort of like technology growth momentum stocks for a long time that is now crashing?
It's interesting. If you look at the forward price to earnings multiple for growth stocks and for value stocks in the US at the moment, I mean, obviously, you normally pay more for growth than you do for value. I mean, that's the definition of the difference. But if you look at the premium people pay for growth, it's really bigger than it is usually. If you go back to a similar premium, it existed in 2000, just before the dot-com bubble burst. So obviously you pay a premium for growth, but the question is, how much do you pay? And at the moment, it's still pretty dispersed. So, if I had to guess, I'd say that there's still further to fall for some of that spec tech stuff. And, every earnings season now, I think is going to be terrifying for even institutional investors, because if something misses, it gets completely destroyed over the course of, 24 hours. So, that's why I think, the single stock stuff is, particularly risky at the moment when it comes to an earnings season. But yeah, I think that probably it's still got further to go. Would I buy Cathie Wood's stuff now? Well, yeah, I'd be more likely to buy it. And in England, we've got something similar called Scottish Mortgage Investment Trust, which is like our version of Cathie Wood's Light. And that's on my shopping list for a market crash. So that's one of the things I would buy if markets were in complete turmoil and valuations were much lower than they are now. So I would buy it, but probably not yet. I certainly got a huge traction because I did a tweet which showed the individual drawdowns for the individual stocks in Cathie Wood's fund. And then one of the FT journalists picked up on it, Robin Wigglesworth, and he put it in the FT. So that was it was great for us. And other fund managers in the UK, very, very well-known ones, have also had similar drawdowns. A very big one is called Fundsmith. And, they had a big position in PayPal, big position in Facebook. And I kind of felt sorry for them because, they're a really good fund manager, very fundamentally driven, very disciplined. They don't have much churn, very big deviation from the benchmark. So they don't hug the benchmark. But they got completely, hammered by this sell-off in those two big stocks. And it gave up like 3 years of alpha when they were literally in the space of a couple of weeks. So it's pretty brutal out there.
Yeah. And if you were the fund manager of Fundsmith or if you were Cathie Wood in Cathie Wood's shoes, who has tons of these stocks in their portfolio, and the reason I'm asking, because I know a lot of our users have a lot of those stocks in their portfolios, or even Cathie Wood's or some of the similar ones. If you were the fund manager, what would you do with your current holding that is down 80%?
Well, I wouldn't change my style because I think, Eric Balchunas, who's the ETF guy on Bloomberg, makes a really good point, which is she didn't change her style, which is exactly the right thing to do. What's really awful is when you get someone like Cathie Woods who, does the research about disruptive stocks, is optimistic and likes tech, and that's just Cathie, right? And if she stopped being Cathie, there'd be no reason to invest in her fund. So, I think the fact that she didn't have style drift is good. So if you believe in it, I'd say stick with it, because the reason why people buy your stuff is because they believe in you and your views. So to be fair, there has been a big outflow from Cathie's fund, but a lot of money has stuck with her. So I think that's because she didn't change. She's still Cathie. She's still publishing the research. She's still transparent about what she does. So all the good stuff's still there. So, I mean, if I was Cathie, I'd just say, screw the world. I'd just carry on doing what I'm doing. I mean, it's just not my style, but that's what I think she should do.
I love it. I think you're very intelligent about the way you approach it. You're saying, if you believe your approach, why would you change your approach in response to pricing? Because nothing else about it has changed. And I believe I was listening to some of her content, and she was saying, actually, when the market is sort of, as she called it, a risk off, and they're trying to like escape to safety, the best thing for a momentum or like a growth stock is to double down on their highest conviction, as opposed to trying to fly to safety. Double down and focus on your highest conviction, because that's where you're going to find the most alpha or most growth in the coming years. And she's doing exactly that. Well, the only disclaimer I would add here is that I have set up an ongoing weekly $1,000 buy into Cathie Wood's ARC, because I thought, I don't know where is it going, and I can't figure out how far it's going to go, but it's really far. And I also believe in her research, so I should basically do something here. And then the other thing is, I balanced it off by $1,000 recurring in SPY, S&P 500, and I said, if Cathie is wrong, at least I'm balancing it out with SPY. So that is my reaction to Cathie's situation, and kind of a continuing on the belief, and then managing my risk by some SPY buying. So we'll see how it turn out. Maybe 5 years from now, we do another episode and we can talk about how my strategy turned out. Well, enough of Cathie Wood. This is a PensionCraft episode. I didn't ask a question that I wanted to ask at the beginning, and that was, why did you call your YouTube channel PensionCraft? Where did the name come from? I'm always fascinated how creators pick up the names. Most people just put their names on their YouTube channel. You went with a very creative name, but tell us the story behind the name.
Well, it's interesting. I mean, my kids, I was always spending loads of time at the weekends trying to set up a Minecraft server for my kids. So I don't know if you've ever had to do that as a parent, but it's a real nightmare, because they want to do mods, and it was just a nightmare. So anyway, I was kind of au fait with Minecraft and how popular it was. So I thought, if you're trying to construct a pension or an investment portfolio, why not call it PensionCraft? Because instead of trying to create some kind of building, you're trying to create a portfolio. So it was the idea of construction and learning, and so that was the idea. I mean, I'd have preferred to call it something like Investment Craft, but that URL was already taken. So that's the very bad reason why I called it PensionCraft. A lot of people have said it's a stupid name. You shouldn't call it that.
I love the name.
We're kind of stuck with it now. So
it is a very good name, and it's it's always like, the first time I heard it, I was immediately drawn to it. And I'm like, this is a very creative name. He didn't put his name on the YouTube channel. He actually thought about the craft of creating investments or pensions.
In America, I guess it would be called 401 craft, because
yes.
your kind of retirement account's called a 401k, isn't it?
401k, yeah, you could call it 401k craft. That's a really good name. I actually we had a similar conversation with another creator on the channel, and his Twitter handle is called 10k diver, and we had a whole conversations about how he chose the 10k diver. So I'm always fascinated how creators come about with their names. I love yours, and I love the 10k diver ones. Those are really, really good stories. Back to the topic of investing. It's like it's a tradition around here on the YouTube episodes and podcast episodes. We always ask, in this current market situation, what is one stock or ETF in your case, or a fund, that you would buy now, and why?
I guess for me, in this kind of current environment, the one I'm buying still is my global equity fund, because that's the one I buy all the time. But that's kind of boring. So, I guess for me, it would be something like our version of Cathie Wood's, which is this Scottish mortgage fund. And the reason why is because, firstly, it's got leverage. Secondly, it's certainly fallen in value a lot recently. I still believe in the ideas behind the fund. The fee's not too high. And I think the governance is great for the UK version, because the way it works in the UK is it's an investment trust. So it's structured as a company which means they have a board. So that means that if the fund manager kind of goes off-piste, then they can actually fire them. And they also push back on any decisions they make if they think it's kind of egregiously wrong. So there is a kind of layer of governance above the fund manager to ensure that they don't do anything too crazy. So, I like the governance. I like the kind of investment thesis. So yeah, I think that would probably be the one I'd go for.
I love it. And in that answer, you could sort of talk about a framework to evaluate a fund. Governance, fees, and investment thesis are some of the most important things you would probably look at when you want to buy an ETF or a fund. So you've answered two questions at a time.
But for me, I should say that's kind of like a blasphemy, because I don't usually go for actively managed funds, but that is an actively managed one. But it's been one I've been watching for a long time. So yeah, I kind of like it.
Very cool. And what is the ticker? Just so that everybody knows, especially if you have UK audience.
So I think it's SMT is the ticker in the UK for the London Stock Exchange.
Gotcha. Thank you. Excellent. Well, we got less than 5 minutes with you, so we play a little game. Usually, we're trying to find things that good investors avoid, and we play this game with. It's a buy, sell, or hold game. I learned this from David Gardner, founder and one of the founders of the Multi-Fool. In his podcast, he would play this buy, sell, or hold game. So I'm going to play with this game with you if you're okay with it. And the idea is that I'll share 3 concepts one by one with you and ask, if it was a stock or a fund, would you buy it, sell it, or hold it? And we can have a little bit of fun about it. So Ramin, are you ready to play the game?
I'm ready.
All right. NFTs, buy, sell, or hold?
Oh, sell, because I don't know anything about them. I mean, for me, it's very much like art. It's subjective, what people are willing to pay for something. I don't really understand the appeal of it, but, I don't really understand it. So I'd probably sell.
Cool. Good. Number 2, Ramin, Metaverse, buy, sell, or hold?
Metaverse I'd probably buy, because, I think particular kinds of stocks in the metaverse are very attractive. So, the companies which create the infrastructure rather than Meta itself would probably be what I'd go for. So the kind of miners, the people that sell the pickaxes to the miners, rather than buying the individual metaverse type stocks themselves. So, something like NVIDIA, which enables the technology, or maybe some kind of Unreal Engine, which creates the kind of graphical framework for it, rather than some huge metaverse stock.
Love it. In Unreal Engine, is that the Unity's product, or is that some other company's?
I believe so. Yeah. I mean, I only know about it because, I do some gaming myself. So,
yeah. Very cool. Nice. All right. So one more. Ramin, crypto or crypto tokens, buy, sell, or hold?
Well, at the moment, I actually have a crypto strategy which is momentum based, and it's telling me not to buy. So at the moment, I'd sell, but literally it updates every week. So, if you ask me in 6 days' time or 1 day's time, I'd probably come up with a different answer. Yes. So that's currently a sell.
Okay, cool. And I did not know that. We should definitely. Is that part of some of the content on your YouTube channel? Is there another channel for?
No, this is for our members. So, we're trying to create strategies for them as well. So I know lots of them do crypto. So, I just thought this would be interesting for them.
Very nice. Just a quick note on that we're working on introducing crypto cards. A lot of our users actually been asking, what about crypto? So we've been working on a framework for evaluating cryptos and understanding their on-chain data, and try to bring that and simplify that to our users. So hopefully we can have that in the next couple of months. But that's a great segue into telling our audience, where can they find you? Where can they read your content? And anything you want to share with them about your newsletter, about your YouTube channel, about your community, please do.
Well, the kind of way in usually is our YouTube content. So if you like that, you'll like the rest of the stuff that we do. We've also launched a podcast recently called Many Happy Returns. The idea being that if you're a long-term investor, you have many returns, and hopefully they're happy. And, we try to educate people. And it's kind of fun. One of our PensionCraft members actually joined with me to create the content. It's Michael Pugh. So that's done quite well recently. And, we're only 5 episodes in, but it's been popular. And also our Patreon community, if you go to patreon.com/PensionCraft, you can join our community there. So that's kind of covers all the bases, I think.
Perfect. And do you publish content every day, every week?
So we have a YouTube video every week, usually on a Saturday. This week we've done 2 because we did one on the situation in Ukraine, but usually it's 1. And then we put the podcast out every week on a Wednesday, and we produce a newsletter every Friday, which is free. And that kind of highlights the rest of our content as well, which is quite newsy, quite short. And I tell you what gets the most clicks in it. It's got a funny dog video, and that always gets the most clicks, which is quite annoying. But I guess that's what people like, right?
Yes, that's what people like. Cat videos and dog videos. Always beat investment videos. Well, Ramin, thank you so much. We'll put a link to all of this good content. I have to thank you for doing this episode, for doing the great work you're doing. You're one of the videos, YouTube channels that I listen to or watch to all the time. And
well, thank you for creating Stock Card while we're doing the thanks. I think it's great. It's really amazing work.
Thank you, Ramin, and hopefully we will have you back in the studio soon. Thanks. Have a great rest of your day.
Do take care. Bye-bye.
Bye.